The views and opinions expressed in this podcast are those of the individual speakers and do not represent the views, positions, or policies of their employer, clients, or any affiliated institution. This podcast is intended to provide general information and should not be considered as health, legal, tax, or financial advice.
The Global Policy Podcast, a podcast bringing together senior executives, central bankers, policymakers, and global infrastructure leaders for the honest conversations the financial system needs. In each episode, we explore the forces reshaping global finance, from agentic AI and programmable payments to tokenization, stablecoins, risk governance, and the regulatory frameworks struggling to keep pace. Today, I'm joined by one of the sharpest emerging voices in capital markets policy. Phoebe Chan is a capital markets policy researcher at the CFA Institute's Research and Policy Center, one of the most influential bodies shaping investment standards and market governance globally. At the Research and Policy Center, Phoebe works at the frontier of the questions that matter most for the future of markets: digital finance, tokenization, private market access, and the investor protection frameworks that have to evolve alongside them. Today, we're unpacking one of the most consequential questions in modern markets. What happens when the gates to private markets and tokenized assets open to retail investors? And whether the rules protecting those investors are keeping pace with the technology transforming how markets work.
Phoebe, welcome to the Global Policy Podcast. I'm really excited to have you here today.
Thank you so much for having me. It's a pleasure to be speaking on this podcast.
Really delighted. I happen to have actually read the Capital Market Policy Meeting report that was actually posted on the CFA's website. I think that actually happened last year. And it's really great to see that there's a lot of member discussion around tokenization, digital assets, and of course, stablecoins. But from your standpoint as a capital market policy researcher at CFA's Institute, what are regulators, institutional investors, as well as other market participants really concerned about, especially when it comes to digital finance, as well as, of course, the private markets? What do you think they're very curious about of recent?
Yeah, I think the simplest way to describe the current moment is that two major convergences are happening at the same time, and that both are changing the structure of capital markets simultaneously. So one is that capital markets are becoming increasingly digital. The infrastructure is becoming more programmable and in some cases tokenized, right? Then the other is that more capital formation is happening in private markets, whether that is private equity, private credit, infrastructure, real estate, or venture capital, right? And access is gradually expanding beyond institutional investors to retail investors and retirement savers. So if you look at that report, actually neither of those developments is inherently negative. In fact, both have the potential to make markets more efficient, let's just say, and help channel capital to where it's needed. But the question we are all grappling with is whether the legal and governance frameworks are catching up with these innovations, right? And that is really what sits behind a lot of today's policy discussions and debates. Take digital finance, the questions regulators, the FCA are asking are really fundamental, right? What does an investor really own? Is it a token legal title, or is it just a contractual claim, or something else, right? So who is responsible for custody, and what happens if a platform fails? So these may sound like really technical legal questions, but at the same time, they are the foundations of trust in any financial market. So the markets will only work if investors have the confidence that their rights are clear and enforceable. Well, for private markets, right, they raise a different set of issues, but they're closely connected. We have seen enormous growth since the global financial crisis.
Yeah.
And the balance between public and private markets continues to shift. While we recognize that private markets play a very important role in financing companies, supporting innovations, but also as they have grown, they have raised questions around transparency, fees, expenses, conflicts of interest, like we've discussed before. I think also the retail assets question, right, is probably one of the biggest policy issues, given these markets were largely built for sophisticated institutional investors who could negotiate bespoke terms and undertake extensive due diligence. We really need to think carefully about whether the same protections are broadening as well. So, I mean, whether we are talking about digital finance or private markets, the underlying challenge is really the same. And you can also see that reflected in the UK. Over the past year, we've seen a steady stream of consultations on digital assets, tokenization, stable coins. And just a few days ago, actually, the FCA published its landmark crypto framework, which is designed to give firms with greater regulatory certainty and strengthen investor protections. And I think that is a really positive development because regardless of the technology or the assets class, investors, they will still need to know what they own, what rights do they have, what happens if something goes wrong. So to me, that is really where the conversation has moved and ultimately what sustains investor trust to participate in capital markets. And thank you so much for sending me those reports and news, to keeping me informed.
Absolutely. You've actually unpacked a lot of things there, which is really great. For the purpose of our audience who have no clue what's going on in the digital finance space at the moment, could we take a little bit of step backward to kind of educate some of us who have actually not been familiar with the market? What is tokenization? What does the regulation really say, for example, from FCA's perspective? Could you kind of unpack that a little bit more?
Yeah, sure. Tokenization is the process of converting ownership rights of a traditional real-world asset into a digital token on a distributed ledger or a blockchain, right? And from what I've seen, I would say there are several links running in parallel, right? So I won't say we have moved neatly from speculative crypto into institutional tokenization. In fact, there are still quite lots of speculative crypto, and that market has not disappeared. I think a lot of retail activity is still driven by momentum, right? Particularly among young investors. Some of them may be listening to your podcast, following your podcast. They rely pretty much on social media and influencers for information. And they are also at the same time affected by gamification. They love using apps, gamified softwares, and they might also be affected by FOMO, right? Fear of missing out and their peers. So my shorthand would be simply hype is not a reason for investment, right? And the second lane, just to give a bit of background, is institutional tokenization. And I think that is where some of the more compelling use cases are emerging, right? For example, tokenized funds and securities, as well as the opportunities to improve settlements, automate part of the investment life cycle, and reduce operational inefficiency, so to speak. And of course, there are also developments of digital money itself, whether there is tokenized deposit or CBDC or stable coins. That is a separate but closely related conversation, because these different forms of digital money could become an important part of the future market infrastructure. So I would encourage, our audience to also have a look at our tokenization research, which also explore, the market developments, the use case, the benefits, as well as the regulatory and policy implications. And also we have our comment letters and regulatory submissions, where we have been taking a technology neutral approach, because at the end of the day, whether an asset is tokenized or not, investors, they will still need a few things, including clear governance, right? Appropriate disclosures, robust custody, reliable valuation, and legal certainty. So these are the fundamentals that do not change.
I think something came to my mind around, the fact that the existing speculative markets, crypto market has actually not, changed. When the tokenization capability now provide access to new type of investors. Who do you think are realistically going to benefit from these specific markets? What does that look like for retail access for private markets?
I think when the gates open to retail investors, right? You asked the right question about what they get access to and how they access them, right? So some investors, they will genuinely benefit, particularly the long-term savers, right? Investing through diversified portfolios, professionally managed vehicles or pension funds, right? Where there is, I would say, appropriate governance, safeguards, and fiduciary oversight. But there is a big difference between gaining diversified exposure through a long-term fund versus investing directly in individual private assets that may be highly illiquid, very difficult to value, or more complex to understand, right? That's because as we all know, private markets are fundamentally different from public markets. So price discovery, valuations, liquidity disclosures, they are a lot more complex in private markets. And you can already see this debate playing out in the UK, right? I think in 2023, 3 years ago, the FCA has broadened access to long-term asset funds, including for the DC pension schemes, while recognizing that these are high risk, less liquid products that would require additional safeguards, such as risk warnings and customer suitability assessments, right? At the same time, you also see initiatives like the Mansion House reforms. They are encouraging greater investments by the UK pension funds into productive assets, including the private market. So to me, that captures the balance that policymakers are trying to make. On one hand, private markets, they can finance infrastructure, they can help growing companies, potentially improve long-term outcomes for savers, right, including you and I. On the other hand, expanding the access to retail investors should not come at the expense of principles that protect investors. So fiduciary duty, robust fair valuation just remain as important in private markets as they are in public markets.
You actually touched a little bit on something that was actually very fundamental, because you mentioned the fact that there are consistent arguments in the markets at the moment around the lack of regulatory clarity. And I think we should actually just talk a little bit about that. When there's actually lack of regulatory clarity, which is of course holding back digital assets and tokenized markets, where is that absence of clarity bringing about some form of investor arm? Where do you think investors are actually susceptible to potential arm?
Yeah, I think the industry is right to ask for regulatory clarity, but let me also break that down into two different kinds of clarity, right? So the first clarity is for firms. Questions like, what license do I need? What activities can I carry out? What products can I offer, right? And the second is clarity for investors. And to me, that is also very important, because investors, they need to know what exactly do I own, right, and where is my asset and how is it being valued, and what about the accountability mechanism, right? So a good example would be ownership record. In some tokenized fund structures, transactions can happen on the blockchain, on-chain, but the legally recognized register of the ownership is actually still maintained off-chain by a transfer agent. Now, that might sound like a back office technical detail, but it's also one of the most important questions when it tells investors which record is legally authoritative, who is responsible, and ultimately how their ownership rights is being protected. And the same applies to, of course, custody, insolvency, client asset segregation, claims against the intermediary, etc. So that's why regulatory clarity matters. It's not just about giving firms the confidence to innovate, but also giving investors the confidence they need, when it comes to their rights, right? Basically, whether the rights are clear, enforceable, and well protected. And I think that is also what unlocks greater institutional participation. When you think about large asset managers, pension funds, and issuers, they all need to understand the rules of the game, right? They need that confidence in in the legal framework, the operations, and how risk are being allocated before they are comfortable deploying the capital at scale.
Right. You touched on regulatory clarity a little bit, and I really appreciate that fact that you've earlier mentioned that the FCA they've actually released a publication around this just about a couple of days ago. But from regulators' perspective, not now we've thought about the industry. From regulators' perspective, there are many regulators around the world now are reaching different conclusions around what retail access mean, tokenization. What do you think? This fragmentation is actually costing the global capital markets, or do you think they're not really necessarily costing us anything? Maybe later in the future, do you think there could be some form of convergence around, what the regulators would actually unify their regulatory purview to be on these particular issues?
Yeah, absolutely. And in fact, I love this question because for someone coming from Hong Kong, Asia, and having spending some time here in the UK, in Europe now, I'm already seeing jurisdictions taking quite different approaches. And if you look across the US and the other markets in Middle East, they are all moving in the same direction, but they are also doing so through different regulatory philosophies, let's just say, and legal frameworks, right? And I think there are actually two parts to this question. The first is, of course, the cost of fragmentation, right? What is the implication? And the second is whether regulatory conversion is actually achievable. Because on the first point, fragmentation does come at a real cost. When tokenized markets, they can only deliver their benefits if markets they can connect with each other, right? Their value depends on scale, trust, interoperability, right? If different jurisdictions define digital asset differently, or they take a very different approach to custody, or they apply different standards of disclosure, then you don't end up with a global tokenized market. You will end up with a lot of digital islands and patchy rules and regulations. And that has real consequences because then liquidity becomes fragmented. You also see higher costs for compliance, and it becomes harder for firms to issue or operate across borders, right? And that's why when you and I first spoke, we recognized the importance of legal clarity, cross-border recognition, and you also seen those arguments in our research reports. And at the same time, having said that, I think we need to be very pragmatic. I don't think we are ever going to see a single rule book because these securities laws or insolvency laws, I'm not going, deep into the details, but just saying the tax systems or the property laws, they reflect different legal traditions, right? And they are different for good, legitimate reasons in order to reflect unique market structures, investor base and policy priorities. So I don't think the goal is a single identical rulebook, but it will be outcome-based convergence, right? In other words, the countries, they do not have to regulate in exactly the same way, but investors should have the confidence that wherever they invest, the fundamentals are the same. And I think the UK is actually well placed to contribute to that conversation, right? Through its leading role and continued work on tokenization, digital asset regulation, is increasingly looking at how domestic reforms, I think the FCA call it a roadmap, right? A roadmap aligned with international standards, including the IOSCO recommendations, rather than developing policy in isolation.
There's a lot of things coming to my mind when you actually mentioned the fact that, there might not be, some unification as such, in the rule book. I don't know why I'm very fascinated about having, the congruence of multiple regulation across multiple jurisdiction coming together. Maybe because I'm an entrepreneur and I'm trying to kind of imagine what that fragmentation cost actually means for example, a cross-border payment business or, institutional business that is working across multiple countries. But maybe I need to park that idea for some time in the future. So in traditional finance, we've got the brokerage, trading, business side of things, as well as the custody, right? And these typically in traditional finance are always very different businesses, different platforms. But what we begin to see in many digital asset markets is the fact that most of these capabilities are now unbundled together in one platform. So you typically will have both the trading, custody, as well as the brokerage on one platform. What does that really mean for safeguard purposes? What does that mean for the entire market, global capital market in itself?
Yeah, actually, I think this is one of the biggest market structure questions in digital finance, right? And you have captured it very well, because in traditional capital markets, right, functions like trading, brokerage, exchange operation and custody, they are usually kept separate. And those separations evolved over time because each function comes with different incentives and different risk. Digital asset markets, they develop rather differently, right? It's quite common for a single platform to perform several of those functions at once. The same firm, they can operate, the trading venue, they can hold customer assets, they can execute trades, and in some cases, even trade on its own accounts. And that is where the risk start to emerge. I'm sure you've seen news and discussions around that, right? So if the platform is also a market participant, then conflicts of interest go right to the heart of market integrity. And investors will need that confidence that, my orders are handled fairly and the platform isn't using the information or the market's power to its own advantage. And if you look at the IOSCO report previously, they have also identified that vertically integrated business models and conflict of interest as some of the key structural risk in crypto asset markets, right? So it is also something that CFA Institute and also our local society, CFA UK, have consistently highlighted in our response to the FCA consultations, right? And I'm sure you're also very concerned wearing your hat of, being an entrepreneur and a key participants in the capital market. So from the CFA perspective, the starting point has to be strong conflict management, right?
Yeah.
Where conflicts can't be managed effectively, then there should be a legal or functional separation, particularly between the trading venues, custody, and proprietary trading. And beyond that, we also support activity-based regulation so that the firms, they are regulated according to what they actually do rather than the technology that they use, right? So investors should know exactly what role a platform is performing and what responsibilities come with that role. And then there are, of course, fundamentals that should not change, segregation of the client's assets, custody, strong governance, capital adequacy, adequate capital, and credible arrangement if a firm fails. So ultimately, digital assets do not really change the principles of good market regulation. And if anything, they actually reinforce why those principles exist in the first place.
I totally agree with you. And of course, what I'm very optimistic to see is that in the next couple of months, there will be some, enforcement of some of these regulatory purviews in real market context. I've seen a lot of activities around where, what the CFA Institute have done largely around providing market access to investors, and which is very great. Looking into the next 12 months, for example, from CFA's Institute perspective, what are you guys doing to kind of push for not just market access alone, but being able to actually help the market scale in a way that it would actually protect investors' interest as well?
Yeah. So, all in all, our role at CFA Institute is really to ask whether the market structure still serve investors and support market integrity as technology evolves, right? And I would frame the agenda around a few priorities. First, legal certainty. For tokenized assets, we talk about the cost and the consequences of not having clarity, right? When investors, they do not know what is going to happen when things go wrong. And without that, tokenization may improve the interface while leaving the legal foundation very uncertain and shaky. Our discussions have all been around these legal framework questions, which are central to responsible growth, right, in a sustainable way. Second, conflict of interest controls. We talk about that because we have to be careful about vertically integrated platforms that combine, venue operation, custody, data, listing, principal trading, right? So if the conflicts are structural, then disclosure alone is not enough. Beside that, fund tokenization, the topic that FCA has just released, the feedback of the previous consultation, right? They should proceed in phases. The objective should be operational improvements and investor benefits, not tokenization as a label, right? And then, of course, private markets, right? I don't think the answer is to close the door or not allowing retail investors to participate. But, the form of assets should be fiduciary-led and protection heavy, right? There should be diversified structures, professional management, valuation standards that match the underlying assets, the transparency, fees, benchmarking, etc. And finally, going back to fragmentation, right? We talk about, the cost of regulatory fragmentation and uncertainty, and that international convergence around outcomes is more likely because we are not, I think we have to be pragmatic here that full harmonization is unlikely, but regulators, they can converge around several things, right? While, it is easier said than done, I think the practical answer to it would be phased development, right? Start, for example, disclosures, right, or conflicts of interest. These are the things that are central to the discussions, and they should be addressed first. And then, once that foundation has been built, then we can proceed to, the second phase or the first phase of development. And for the UK specifically, the opportunity is to show that a growth agenda and a high investor protection standard agenda, they can actually reinforce each other. They don't have to be necessarily competing with each other. And the FCA has actually said that its secondary objective is not about lowering the standards, but about facilitating competitiveness and growth, also advancing consumer protection, market integrity, and a fair, capital markets and effective competition, right? So that is exactly the right formulation for the future of the UK capital market.
I'm really looking forward to that future, actually. It's been a very insightful conversation with you, Phoebe. I'm really looking for other opportunities to actually expand some of the questions, and we begin to see some of the practicability of these frameworks and regulation in the next couple of months. It's been a very good opportunity to have a chat with you, Phoebe. Thank you so much, and looking forward to the next podcast.
Likewise, I look forward to staying in touch.
One of them is like that, a self-directed one where the agent takes on responsibilities or actions that are unacceptable. And a second one, which I didn't talk about, is the adversarial one, which is things like prompt injection. So it turns out, and there was a really interesting recent paper on this, LLMs fundamentally suffer from role confusion. They have a hard time telling the difference between a user-entered command and a command that is from the information they're getting. And what that means is that an adversarial prompt that's in a web page that an agent reads can actually cause an agent to act. And so those two things together really highlight the fact that you need hard boundaries on what an agent is able to do.